Accounting is about communicating information to people who need to make decisions. Generally speaking, in this class, we'll talk about the owners of the business, and the owner has to make some sort of decision. Or you might need the bank to make a decision on a loan, whether they're going to give you money or not. These people that need to make decisions, that need the financial information, are called stakeholders. So these stakeholders, whether it's the bank or whether it's the owner, they need financial information to make sometimes very important decisions about the business. And now, we have gone through ways of recording all sorts of transactions, but we're not going to go give an entire spreadsheet over to the bank and say, hey, here's all of our transactions for the past year. And the bank's going to be like, can you summarize this for me? And so generally speaking, the people who want the financial information don't want all of it. They don't want every single detail, every single thing that happened in the business, every single transaction. They want it in a summarized format. And so the main way that we can communicate this information is in what's called the financial statements. You might already be familiar with some of these terms because they are often used in everyday life, like the income statement or profit. When you hear the word profit, guess what? Hey, that's what we do. So we communicate what is the profit for the business. Again, the main way that we are able to communicate this information is in the financial statements. This is kind of our whole purpose as accountants, is to create these financial statements so people can make decisions about the business. The financial statements are a summary of what has happened in the business or what the business owns and owes at a certain period of time. And so we format it all nice so that people can get the information and read it and understand it. All right, so there are 4 basic financial statements. We're mainly going to focus on 2 of them, but we have to talk about all of them since they're all related to each other. The very first one, and this is the one most people are familiar with, is the income statement. This one is, we list out all of our revenues. So all of the work that we have done, what we have earned, and then we subtract our expenses. So all the resources that we have used, this might be, for example, our employees, it might be supplies, it might be advertising. So all of the stuff we spent money on. Again, expenses aren't necessarily things we spent money or cash on, it's things we've used up. But we often like to think of this is what we spent our cash on. So revenues minus expenses is our net income. All right, and this is often called the profit of the business. So you probably have heard that word, the profit. That's usually what people are talking about is revenues, expenses, net income, or profit. And even little kids understand this concept. My young son ran a lemonade stand this year. And we kind of talked about this whole thing, that he was selling lemonade. He had to go buy the lemonade, buy the supplies, buy the cups, and everything else involved with the lemonade stand. And then he had to sell it. So we talked about the concept of, all right, you sold the lemonade for $1. Everything that you spent cost about 50 cents. So your profit when you sell each cup of lemonade is 50 cents. So that was the concept of revenues, is how much did you charge for your services or for your product. Expenses are how much did it cost you to provide all the services and products. And net income is what is left, right? So All right, the next one, I'm going to put it all the way on the right here, is the balance sheet. So the income statement and the balance sheet are the two main financial statements that people look at. The balance sheet shows a summary of what we own, or the assets, what we owe, or the liabilities, and what does the owner get? So what's the owner's equity? You might look at this and say, hey, that looks kind of familiar because this is the accounting equation. Assets equals liabilities plus owner's equity. And the balance sheet is formatted that way. So we are going to list out all of our assets. You might have cash. You might have supplies. You might have equipment. And you list that all out and say, all right, this is how much cash I have. This is how much in supplies I have. This is how much equipment I have. I'm going to add that all up and I'll get my total assets. And then I'll list out all of my liabilities. I might have accounts payable. We talked about accounts payable are just generally things that we owe from running our business. We might owe our suppliers. We might owe advertisers. We might even owe employees or something like that. So accounts payable. We might have a bank loan out there, so things like that. So just listing out all the things that we owe. And then we'll get total liabilities. Now, owner's equity. In this class, we are using a sole proprietorship. Sole proprietorship means there's one owner. And the owner's equity section in a one-owner business is very simple. It's just capital. And so that's just if we have all of our assets, sold all of the assets, and then paid off all of our debts, that's essentially what the owner has left, right? So that's the capital. We can see if our balance sheet worked, easily see if it worked, because if we add up our liabilities and our capital, that's actually what we put at the very bottom of the balance sheet. We put liabilities plus capital. Guess what? That has to equal our total assets. So those will often be double underlined to show that those two numbers are supposed to be the same. That is the accounting equation. Assets equals liabilities plus owner's equity. All right. So there is one financial statement that is the glue between the income statement and the balance sheet. And that is the statement of owner's equity. This one is a very short financial statement, but it shows how did the owner's stake in the business, so how much did the owner own of the business, how did it change during the year? So for example, on January 1st, maybe the owner hadn't even started the business. The owner put money in the business. The owner took money out of the business. And then we take our net income. Well, guess what? If the business earns money, who does that money belong to? Well, it belongs to the owner. So that also figures into this statement of owner's equity. So this one is, we have beginning capital. So what was it at the beginning of the year? We add in owner investments. So did the owner put any money into the business? Did the owner take any money out of the business? So we'll subtract our drawings. And then as we said, well, if the business earns money, who does that money belong to? It belongs to the owner. So we're going to take the net income that we calculated over here and add it in. Now, if we lost money, well, guess who lost money? The owner lost money. So if it's a net loss, then we, of course, subtract it instead of add it. That gets us our ending capital amount. All right, and then we take our ending capital amount, and that's what actually goes into the balance sheet over there. So we can see that these are all tied together. So income statement, revenues minus expenses equals our net income or our profit. The income statement is also called the profit and loss statement. You may have heard that term before thrown around, especially if someone uses some accounting software like QuickBooks. They call it a profit and loss statement instead of an income statement. I will use the term income statement in this class. So that's the first one that you have to do. To get this whole process started, we first have to create the income statement. Then we run over to the statement of owner's equity, gather this information, put it all here, and then we can go ahead and finish our balance sheet. Now, you'll notice here that if you make a mistake in the revenues or the expenses, so even on this very first financial statement, guess what? That mistake flows through all of the financial statements, and then your balance sheet will be wrong at the end too. So making one mistake in this process is going to throw it all off. So just make sure that you're being very careful and doing the numbers correctly here. Otherwise, you're going to end up with total assets does not equal liabilities plus owner's equity, and you will have no idea where in the process you went wrong. It could be anywhere if these don't end up right. All right, so I said that there's 4 financial statements. The last one is the statement of cash flows. Now, we have said that revenues is not necessarily cash. This is just the money that what you have earned, the work you have done, whether or not you've actually gotten paid. Expenses are resources that we have used. Again, not necessarily cash. It could be other stuff, and maybe we paid for it, maybe we haven't. We don't know. So net income is not the same thing as cash. But is cash important for a business? Yes, it is. You might hear the term cash is the lifeblood of the business. So none of this stuff actually tracks where cash is coming or going to, coming from or going to. We have a separate financial statement just to show what happened to our cash. Now, on the balance sheet, we just have how much cash we have, but we kind of want to see more details. So that's the statement of cash flows. That is an entirely different, it's a very complicated financial statement. For now, all we're going to do is show you on the statement of cash flows, we're going to have 3 different categories of where our cash is coming from or where it's going to. And so we have our statement of cash flows. And it's either going to be operating. So that's the running of the business. So operating means, did we get money from running the business, like from our customers, or did we lose cash from running our business? Could be because of expenses or paying off our bills or whatever it is. So the actual running of the business, did we get money? Did we get cash, or did we spend cash running the business? Then there's the investing section. Generally speaking, this is investing in the business. So how do you invest in your business? Well, you buy equipment. So that's usually what it is. Like if you're buying the manufacturing equipment to run it, or cars or trucks, or the things that the big stuff that you need to run the business. That's the investing section. And then there's the financing section. How did we get the money to start the business or run the business? You can think of, generally 2 places that we can get money to start a business. One is we get it from the owner, or 2, we get it from the bank. So those are generally the 2 places that 2 things that go in the financing section are money we got from the owner, or money we paid to the owner, or money we got from the bank or paid to the bank. So we're going to look at all of our cash transactions and say, all right, is that operating, investing, financing? Summarize it all, and that ends up as the statement of cash flows. There's a lot more formatting that goes on in there, but I'm not going to cover that in this video right now. So the main things we need to remember, though, are income statement, statement of owner's equity, and the balance sheet. Those will be extremely important to remember how all of these things are related as we go through the semester.